Hi, and welcome to today's webinar with myself, Måns, and Nick from the ESG team at Ausbil. So Ausbil has integrated ESG, or environmental, social and governance, for many years. And the purpose of today's webinar is really to provide a summary of the latest trends in ESG as it's constantly changing. And I think we're heading into what we call uncharted territory this year. So the way we will run this is as follows. So first, we want to provide a recap on what ESG integration actually means. Also how it can pay off and how ESG can be integrated in practice. And then second, we want to go through a number of recent trends that we're seeing in the market at the moment, which we think will be quite prevalent in 2020. And we'll do a deep dive into three of those. So first, climate change and what that means for investors, where we will be covering off something called the TCFD, or the Task Force on Climate-Related Financial Disclosures. We'll cover that in more detail. And then second, the increased problem of plastic waste and the impacts from an investor perspective on that. And then thirdly, increased focus on human rights by investors, driven by the new Modern Slavery Act. We'll discuss all of these things in more detail. So we'll aim to do this in about 40 to 45 minutes. So if we go to the next slide, please. ESG stands for environmental, social and governance. And that can mean a lot of different things to different people in the investment industry. But to us, it really means two things. First, better informed investment decisions, because you're taking into account more factors than normal. Like you look at environmental, social and governance factors that the market might have overlooked. They might have mispriced them or misunderstood. Or you can make better informed investment decisions that way. And essentially, you're taking more factors into account. And then second, engagement with companies on ESG factors, because by engaging on ESG factors, you can preserve invested capital and avoid certain ESG risks. So, investors increasingly integrate ESG for a number of reasons. The first, as I said before, better informed investment decisions, because there's a greater realization of these factors affecting valuations and earnings. And a good starting point is to look at this chart here. It looks at company valuation and what actually drives company value. And the graph is showing the relative proportion of a market capitalization that comes from tangible assets versus intangible assets. And historically, as you can see here, the majority of a company value comes from the net tangible assets, the gray bars. Now, in 2020, the opposite is true. The majority of value comes from so-called intangible drivers, which are things you can't always see in a financial statement. And examples of those intangible assets will be things like corporate culture, corporate governance, staff engagement, supply chains, supplier relationships, customer satisfaction, etc. And broadly, you can divide them into E, S, and G factors. So by assessing how companies are managing their intangible drivers, which are large drivers of company valuation, you can naturally make better informed investment decisions. Second, as we've seen in the past, a number of ESG events have had a significant impact on company share prices, from tailings dam disasters in Brazil to conduct issues in the banking and wealth management industry to underpayments in the franchising industry, etc. And then third, societal values are also changing, and that means new types of demands on companies. And companies that don't look after their safety risk for its people might find it harder to attract and retain a productive workforce. Companies that don't care about gender diversity might find similar issues. Mining companies not managing community stakeholders might not get approval to build their new facilities in that local community, etc. And also companies that tailor their products and services to these changing demands might find new revenue opportunities. So for instance, building products with sustainability features, mining companies supplying lithium for electrical vehicles, etc. And this change also impacts investments as people put more demands on how their money is being invested. And as you can imagine, there are many types of ways you can integrate ESG in practice. Let's see if we can get that slide. I think we're stuck on the wrong slide. So I'm just going to try. There we go. Thank you. So 10 years ago, we used to think that there was a lack of ESG data available. But now most companies report on key ESG metrics, and some companies issue very comprehensive sustainability reports. So there's been a big change there. There are also more research providers that rate companies on their sustainability and ESG credentials, and they sell their services to investment managers. Their research is typically based on company disclosure only though. So for Australian equities, we think the market is small enough for us to do our own proprietary analysis. And we use a team of 3 in-house ESG experts, including myself and Nick. So we've chosen not to buy ESG research from an external party. And our ESG research team is part of and sitting in the middle of the investment team. So we participate in investment team meetings, and more importantly, we also participate in company meetings. And we've chosen that strategy because that's how we feel is the best way for us to get unique insights that we can trade on. And just to give you an example, some years ago, by trawling through social media, we discovered anecdotes about underpaid workers at a particular franchising company. And the more we looked in social media, the more we found. And at the time, the stock was trading at 60 times price to earnings. But we thought the revelations about underpaid workers, if and when they came out of media, could have a major impact on the share price. So we made the call to stay away from that stock, and then we even took a short position. And then a year later, media started writing about these underpayment issues, and the stock tanked. And we think that's a good example of how we actually use ESG research in practice to make better informed investment decisions. But it's also a good example of why we do proprietary research, because third-party research is based on company disclosure only. So you would not necessarily get that information about underpaid workers on a proactive basis. And then some third-party researchers also sell services where they score fund managers on their portfolio based on third-party providers' own ESG scores for individual companies. But we would be a bit careful about using that. First, we might have a different ESG view on different companies compared to the third-party provider. And more importantly, the analysis also ignores engagements that the fund manager does to make them improve on ESG, which is not always reflected in today's ESG scores. Now, how do you assess companies in ESG, and how do you actually take that into account in the investment process? Well, obviously, there's different ways you can do that. We think it's a bit dangerous to assign a certain percentage weight to ESG in an investment process. In some cases, companies have completely collapsed due to ESG issues. So in theory, that weight should have been 100%. But in other cases, ESG just plays a tiny role in the investment decision. At Ausbil, we use ESG scores from 1 to 5 on each company in the ASX 200. But an even more important output from our team is a company-specific ESG SWOT analysis, so strengths, weaknesses, opportunities, and threats. And that looks at all risks and opportunities from an ESG perspective. And then we discuss these risks and opportunities with every stock analyst, and then they're taken into account in their final investment recommendation. And importantly, the ESG SWOT is done in a way that it fits with our investment philosophy. So the answer is the so what question. And to us, that's a really key message from this webinar, because you hear a lot about ESG integration, but the key point we want to make is if you integrate ESG, it needs to be done in a way that's linked to your investment philosophy. Otherwise, there's a risk it's going to be an overlay or something separate. So for instance, at Ausbil, we believe earnings revisions drive share prices, and we prefer companies with sustainable earnings and quality management. So we think it's quite easy to see how ESG fits in with that. So for instance, on earnings revisions, I discovered safety issues with a particular trucking company a few years ago and pointed out the risk of that company losing customers because of the safety track record, and that's exactly what played out. More importantly, on earnings sustainability, if a business model relies on, say, underpaid workers, underpriced pollution, weak regulation, or misinformed customers, we think current earnings will not be sustainable over the long term. And as an example, what happened in the payday lending industry a few years ago is a good example of that. So customers didn't quite know what they got themselves into, and the regulation was very lax. And it was just a matter of time before that would change. And when it did, the sector derated. But let's not be too hung up on just earnings, because at the end of the day, when we research companies, we look at a large number of metrics, and obviously not all of them have an impact on earnings. Rather, we see the way a company deals with ESG issues as a bit of a proxy for management quality. So for instance, if a company has a white collar workforce and they're paying lip service to an issue like gender diversity in 2020, the immediate earnings impact will probably not be very big, but what does it say about management, and how will the company be able to attract and retain key talent over time? That's the bigger question for us. So if two companies are similar on everything else, but one has a worse ESG profile than the other, we think the company with a worse ESG profile should be trading at a discount to the other. So even if it's not earnings related per se, it can still impact the valuation of the company. Now we're going to take a look at some of the trends in the responsible investment industry. So I'm going to pass it over to Nick.
Thanks, Måns. So according to Morningstar, investors last year ploughed a record US 21 billion or Aussie 32 billion into socially responsible investment funds in the US. That was almost quadruple the rate of inflow of 2018. A recent study that's just come out claims that companies with the best environmental, social and governance scores have opened up what one analyst is calling a monstrous valuation premium in a sign of rampant demand. Both of these point to societal expectations changing massively, and that is directly influencing capital flows. According to a CEO of a company we met during the reporting season, this driver is actually more important than regulatory change on something like the transition to cleaner energy. Another way to demonstrate the increase in responsible investment is to look at the growth in assets under management under the PRI, or the Principles for Responsible Investment. This is a coalition of investors globally who have committed to 6 responsible investment principles, including to integrate ESG in investment decisions, engage with companies on ESG issues, and to report on those. As of late last year, the PRI signatories had about $90 trillion in assets under management. Australia and Oceania had 152 signatories, and we are one of those. Another data point would be that as of 2017, 55% of asset owners consider ESG and active ownership in the selection of and monitoring of external managers. By 2018, that number had risen to 86%. ESG has also evolved over time. It started out as ethical investment, where investors were screening out companies they did not like from an ethical perspective. Typically companies in gambling, tobacco and weapons, and they typically did so with no regard for returns. They wanted to invest with their hearts. Now, if we fast forward to today, investors are increasingly integrating ESG in order to make better informed investment decisions for the reasons we've mentioned before. So the landscape has shifted away from ethical considerations to ESG driving better returns. I don't think that shift can be overstated. A move from ESG being about swapping value for values into it being truly integrated into an investment process and driving a better overall understanding of risk in an investment has resulted in the outperformance thesis appearing and then solidifying over time. ESG integration driving better returns has been a moving feast for the last decade or so. It's a new industry with a very patchy data set, both in quantity and quality. Whilst we have our own opinions and outcomes on the returns that can be generated, I think it's important to look at some of the research that shows performance outcomes from utilising ESG properly. So what is the research showing? The literature is showing that investing for sustainable returns with an ESG approach does not necessarily sacrifice returns or cost the investor more, and may indeed enhance both the risk and return sides of the investment coin. This research comes from a variety of different angles, but generally aligns with how we approach ESG ourselves. Some of the key points that have been found are that returns against ESG data show clearer benefits when material ESG issues for a firm are compared to relatively immaterial. You're seeing higher growth in profit margins and a higher risk-adjusted returns. Another would be that ESG is informative in finding risk, extending and complementing traditional risk models, and that the worst ESG stocks have higher volatility and a higher beta. There's also been an increased focus on ESG from a momentum perspective. One study showed that a strategy of taking long positions in companies demonstrating this positive performance momentum and shorting those with negative momentum generated outperformance. Whilst this is just a small subsection of the current research, and as the industry matures, there'll be more to follow, it does show that there is now research supporting the thesis that ESG integration into an investment process does not necessarily detract from returns, and in some cases can improve the risk-returns balance. We're currently writing a thought piece on this subject, so there'll be more to follow for those that are interested, but for now we might move on. Another trend in the responsible investment industry ties back to the evolution of responsible investment that we mentioned before, away from divestment and to a hold and engage strategy instead. This is driven by a number of reasons. First, If you only invest in Australian equities, you only have a small universe to play with. So we'd argue that you're naturally incentivized to engage with companies on ESG issues. Second, many investors are universal owners, which means that it's not easy to diversify away systematic risks, such as climate change risk. For instance, on climate change, there's a major collaborative engagement called the Climate Action 100+, which we will discuss later in the webinar. However, there are signs that globally this trend is changing towards divestment again. For instance, BlackRock came out late last year and said they were going to divest companies with certain attributes, such as a major earnings exposure to thermal coal. We're going to discuss climate change in a bit more detail later in the webinar. So this ties in with another theme, which is that investors want to see outcomes. Investors want to see actual and real outcomes from their engagements. Engagements serve many purposes. As we mentioned before, it can help preserve your invested capital, and engagements can help you make better informed investment decisions. But there's also a returns angle, because there is another trend in responsible investment, and that's increased focus on ESG. The point being this: from a returns perspective, you can avoid the worst performers by avoiding investing in companies with poor ESG profiles. Conversely, if you only buy companies with very strong ESG profiles, you can potentially end up with an expensive portfolio. Therefore, from a returns perspective, we think it may pay off to invest in companies that are improving on ESG, or what we call a positive ESG momentum, because these companies might end up trading at a premium valuation over time as their earnings become more sustainable. We think looking at stocks from an ESG momentum perspective makes a lot of sense. For instance, whenever you speak to a mining company, they will tell you that they see their performance on safety as a lead indicator for operational performance, as do we. This is a reason why we closely track safety performance in terms of trends, negative or positive, in the resources industry. Also, for more people-heavy industries, such as banking, telcos, and retail, we track trends in staff engagement, because we know that there is a link between staff engagement on one hand and customer satisfaction on the other. And customer satisfaction is increasingly important in a world with increased competition. There are websites where you can track what employees think of the culture where they work, what they think of the CEO, what they think of a company's business outlook. This helps us with our ESG analysis, but it also helps us with our engagements with companies. The analysis provides a basis for further discussion. So the UN SDGs, which is the next slide. So while we wait on that, there we go. So there's a framework which often guides companies' sustainability strategies and also some investors' engagement activities. So that framework is called the United Nations Sustainable Development Goals, or the UN SDGs. This is a collection of 17 sustainability-related goals set by the UN for the world to achieve a more sustainable world by 2030. Examples include clean water and sanitation, climate action, and reduced inequalities, each of which has a number of specific sub-targets. Some investors are mapping their investment portfolios and engagements according to these goals. At Ausbil, we don't do so specifically, but many of the issues we've engaged on, even before the SDGs came into effect, relate directly to one or many of the SDGs. For instance, many of our engagements on climate change tie in with Goal 13, which is climate action. We're also a bit skeptical about the marketing around how the SDGs apply, and we think there'll be a fair bit of greenwashing, which is a term describing an investor exaggerating their ESG credentials or impact. For instance, it would be disingenuous if we said that we invest in a company like CSL because of the SDGs. Even though CSL's activities are aligned with some of the SDGs, we invest in them because of how we see the company's earnings going forward. The point of the SDGs is to make an impact on sustainability between now and 2030, and that's very important to remember. Also, many of the SDGs relate to actions only governments can take, so the influential capacity for companies and investors is naturally limited. Nevertheless, we find it as a useful framework for investors to build their engagements around. So hopefully that gives you a base in terms of what ESG is, how it's grown, and also evolved over time. In the next part of this webinar, we wanted to do a deep dive into 3 key themes that are very topical for ESG integration at the moment: climate change and the TCFD, then plastic waste, And finally, human rights and something called the MSA, which stands for the Modern Slavery Act in Australia, 2018. I'll now hand back over to Måns and we'll move forward. The next slide.
Thanks, Nick. Just waiting for that slide to come up. So if we start with climate change, I mean, we're not scientists, so this will not be about the science itself, but it will be about climate change and what it means for investors. So the Paris Agreement was signed by 196 countries in 2016, and that was shaped within the UN Framework Convention on Climate Change. And the whole goal of that is to keep the increase in global average temperatures to well below 2 degrees above pre-industrial levels, preferably lower than that at 1.5 degrees. So why 2 degrees? Well, scientists tend to agree that global warming above 2 degrees could lead to an ecological disaster. But based on the current policies around the world by individual countries in response to the Paris Agreement, we're not going to get there by 2100. So this slide here is just showing some commitments made by individual countries in the Asia Pacific region, and also the existence of carbon pricing mechanisms in the world. But the short story to remember is this: if we want to limit climate change to below 2 degrees, this means we need more policy change. So if we go to the next slide, please, while we're waiting for that to load up. Climate change has also been flagged as a major economic issue, for instance, by the World Economic Forum. But it is a very complex issue with many moving parts. So from an investor perspective, I guess climate change can be seen through two different issues. So first, you've got physical climate change. That means risks and opportunities from an increased number of and intensity of extreme weather events. It's not just about rising sea levels by the end of a century, but also bushfires, floods, hail, hurricanes, droughts, cyclones, etc. Some companies argue that we've already seen the beginning of that. And then the second part is transition, and that refers to government action to curb emissions and also technology change. So for instance, if a country wants to cut their emissions significantly by 2050, have a wide range of policy options from a tax on carbon, an emissions trading scheme, new emissions vehicle standards, reduction of waste to landfill, etc. But transition is not just about policy change, it also means technology change. For instance, hydrogen can be used for steel production perhaps in the future. And if that's the case, it would significantly cut CO2 emissions. If I come back to policy change, it's a very tricky area. And while some European governments are moving ahead, there's been a policy vacuum in Australia and many other countries for a long time. One interesting trend we've seen in the last year or so is that while many governments are dragging their feet, companies themselves and also investors are moving ahead. So in the last reporting season that we just went through in February, we saw more and more commentary around climate change by ASX listed companies. And a number of companies have also set climate change commitments and CO2 reduction goals for the long term, for instance, by 2050. And we've also seen goals for the medium and short term as well. And this has already been happening overseas for quite some time. So one example is Shell in Europe. That was the first company a few years ago in the oil and gas industry to introduce a net carbon footprint ambition, which is an intensity concept associated with everything about their product, from exploration, processing, and the use of it, and all the inputs as well. And that means it covers all of the scope 1, scope 2, and scope 3 emissions. So just to explain that, what that refers to, scope 1 emissions relate to emissions from direct operations. So for instance, if you burn diesel in your operations, scope 2 relate to emissions from electricity you've used, while scope 3 emissions relate to the other side of the value chain. So for instance, for a company like Shell, it means the emissions created when a driver uses a car that's using petrol produced by Shell. So if there was a price on carbon, for instance, through a carbon tax, a company would incur a tax on their scope 1 emissions, but also face higher costs for electricity if it comes from fossil fuel, because the electricity provider there will just have to pass on the tax they have on their emissions, which becomes the user's scope 2 emissions. So it's interesting to see that Shell has a goal to reduce scope 1, 2, and 3 emissions by 20% by 2030, and then 50% by 2050. And they've also linked these goals to executive remuneration. In Australia, we've seen a number of companies also make commitments on both long-term targets and, more importantly, short to medium targets for emissions, although mainly for scope 1 and 2 only. BHP is interesting in an Australian context because they've also committed to set Scope 3 emissions targets, and they'll probably do so this year. How they do this in practice remains to be seen. Their Scope 1 and 2 emissions relate to their own emissions, but Scope 3 emissions relate to, for instance, the emissions created by Chinese steel manufacturers using BHP's commodities for steel production. So that's going to be quite difficult. And it's tricky even for a company of BHP's size to work on emissions produced by their customers, but that's what they've committed to. So we go to the next slide, please. Thank you. So how should investors address climate change? Well, there are many ways and no single answer there. I think historically investors have focused heavily on carbon emissions. Some have been asked to do something called carbon footprint analysis on their portfolio. So carbon footprinting means measuring the emissions in the portfolio and then contrast that to the benchmark. That means effectively, if you have a lot of mining and energy companies, you might have a higher average carbon emissions intensity metric than the benchmark. And that can be a good starting point and it provides some insights, but we think it's a bit of a blunt tool. It may be useful if you think there will be a price on carbon, but you still need to make assumptions on companies' abilities to pass on the carbon cost. And you also need to make assumptions on financial assistance a company might receive from a government. So for instance, when we had a carbon tax in Australia, many companies were actually compensated financially by the government. Now, we think it's not necessarily right to say just because a company have high carbon emissions, they're at high investment risk. We think it's a bit more nuanced than that. And practically, there's some challenges too. The carbon data you use for carbon footprinting is often unreliable and it's often based on old data, which means it doesn't really capture future trajectories. So some companies might decarbonize over the next 30 years, but using data that's historical, so it doesn't really reflect the climate change risks and opportunities. The other thing it doesn't factor in is any engagements you do on climate change. And then lastly, perhaps more importantly, it doesn't factor in physical climate change risk. And we would argue that a company, say, like the Australian Agricultural Company, which owns a lot of land, that will be at higher overall climate change risk from a physical climate change risk perspective than, for instance, a steel company that might receive assistance from a government under a price on carbon. So I'm going to pass it over to Nick again to talk to you about the TCFD.
Thanks, Måns. So something different is needed, and the TCFD provides that framework, the Task Force on Climate-Related Financial Disclosures. This refers to a set of voluntary disclosure principles around climate change, where it focuses on risks and opportunities from climate change. It's asking companies to outline how they believe they will be impacted by a world that is decarbonising. It's complex, however, and not an easy task, but for instance, many mining and energy companies have started to produce TCFD reports. The TCFD covers 4 areas: governance, strategy, risk management, and metrics and targets. And a key recommendation is to do climate change scenario analysis, including a 2-degree global warming scenario. The scenario analysis is probably the trickiest part. Each scenario needs to capture risks and opportunities from policy change, technology change, and physical climate change. Typically, a company would analyse the impact on their business in a world of 1.5 to 2 degrees warming, which means increased policy change, and also one scenario assuming that global warming will be much higher than that. For instance, a thermal coal company might see a major reduction in demand in a 2-degree scenario, but be less impacted in a world with less policy action. It's important to note that it's also about opportunities. For instance, Rio Tinto, which has divested its thermal coal assets, sees opportunities for its copper and aluminium in a decarbonised world, where copper is needed for electrification and aluminium is a lightweight material. Investors are also recommended to use the TCFD guidelines and report against them. It's even bigger for investors to do scenario analysis on all the companies invested in. At Ausbil, we've progressed our own analysis in preparation for our reporting. But once the quality of the reporting by the companies themselves improve, it's going to make life easier for investors as well. Next slide. Another trend. Just move on to the next slide. There we go. So another trend is that of regulators increasingly commentating on climate change, including APRA, ASIC, and the RBA. In the last few years, investors also have had to make up their minds on how to vote on shareholder resolutions related to climate change. A number of companies, mainly in the energy and mining sectors, such as Origin, BHP, Rio, and Santos have faced shareholder resolutions urging them to issue TCFD reports, setting scope emissions targets, and more recently to distance themselves from industry associations which are seen to act against the position on climate change that the company has taken. This is a trend that is unlikely to go away soon, and the level of support for the shareholder resolutions has actually increased over the past year or so. In addition to AGM voting, investors can also engage with companies to make their voices heard. Ausbil was an early signatory to something called the Climate Action 100+, which has become the biggest global engagement initiative with 367 signatories with US 34 trillion in assets under management. So it's got a fair bit of weight. Climate Action 100+ is asking many of the things that the TCFD refers to: strengthened governance and risk management around climate change, scenario analysis, and also emissions targets. Ausbil is currently involved in 6 Australian company engagements, and pleasingly, most companies have responded well to that engagement. Another thing to note is that over 70% of the constituents of the MSCI World Index have supported the Paris Agreement and/or called for a price on carbon and/or the use or will use a price on carbon. In other words, there is significant expectation of support for policy action in the corporate world. So the bottom line on climate change is this: we're foreseeing an inevitable policy change, and in the meantime, companies are preparing themselves for a decarbonised world. Many diversified mining companies are rebalancing their asset portfolios for the future, where lithium and copper might be in greater demand. Contractors like Worley want to transition itself away to capitalise on the decarbonisation, which they are seeing as the biggest opportunity in a decade. Insurance companies are more open about physical climate change risk than in the past. So let's leave it there on climate change and turn to an adjacent issue instead, namely plastic and waste. Next slide. So plastic, it's an interesting and pervasive problem. Of all the plastic packaging produced on Earth, only 14% is recycled. A recent study found that the ocean contains an estimated 150 million tonnes of plastic, with 8 million tonnes added annually. That's roughly equivalent to a garbage truckload every minute. At Ausbil, we've seen this coming for a little while, and we've been positioning ourselves in our portfolios in order to react to the risks that we believe plastic brings. We see it as a systematic issue that needs a systematic solution, and that's why we've joined the PSIA. It makes sense for us to collaborate on this, and we think it makes sense for other investors to join this as well. Working alongside groups like the PSIA, we also see taking action on plastics providing significant opportunities in tackling the problem that fits within the framework of the UN SDGs that we mentioned before. We see the culmination of plastic developments creating 2 major investment themes: the changing demand profile for plastics and packaged goods, and the regulatory transition to a circular economy. We've seen plastic production growing dramatically when compared to other commodities and chemicals, and even growth in world GDP, as is illustrated on the current slide on the left there. Plastic has clearly outpaced the production of aluminium, ammonia, cement, steel, and world GDP. The impact of plastics is doubly concerning, given that their production accounts for some 33% of global oil demand growth in 2030. ESG is a multifaceted topic, but the issue with plastic returns back to the heart of sustainable investing. If a company's business model relies on underpriced pollution, weak regulation, or unpaid externalities, we do not think that the current earnings are sustainable. And we do believe that there is increasing incoming regulation, which we've seen play out over the past months. We've seen countries across the globe react to this issue, from China with its national sword policies a couple of years ago, through to France more recently banning single-use plastics. This regulatory shift from different nation states has had a wide-ranging impact across the world. The trade in global recycling waste changed fundamentally in 2018 when China implemented its national sword policy and began stringently enforcing regulations on waste imports. Until China began curbing recyclable waste materials, it was importing some 30 million tonnes annually, of which around 1.25 million tonnes was from Australia. The key issue in this is that emerging economies are no longer accepting contaminated waste from developed markets, largely due to pressure from their constituencies. And we believe they're weaponising waste in their foreign affairs policy. So across Asia, there's a lot of political will to reduce the plastic waste lost into the ocean, and many governments are working on the problem, seeking opportunities, such as waste to energy conversion. Importantly, there seems to be an opportunity for Asia to leapfrog the Western developed economies. The impact that this has had on Australia and how Australia deals with waste has been significant. Deprived of a profitable export market for our waste, we've seen a marked change in the Australian waste management industry. The highest profile scalp so far is probably SKM Recycling, that went into liquidation and has since been picked up by Cleanaway. Local governments are also scrambling for ways to fix this, with Victoria raising its landfill levies, enabling recyclers the ability to generate returns sufficient to fund further recycling projects. A broader rollout of the container deposit schemes has also been seen. This shift still has ways to go, with regional recycled plastic manufacturing industry yet to play out. On the demand side, we believe consumers will drive the demand for change away from unnecessary plastic packaging. There has already been a shift by the major FMCGs, or fast-moving consumer good companies, and other large users of plastic packaging into recycled content across their packaging portfolios, as evidenced by Unilever, Woolworths and Coles in their active commitments to reduce single-use plastics in their packaging. Already, FMCGs that represent 20% of global demand for PET have put in place strategies to move towards 30% PET reductions by 2035. So to wrap that up, plastics are a growing issue across a range of risks and present two clear investment thematics. One, a shifting consumer demand profile, and two, a regulatory transition to a circular economy. By being aware of these and influencing companies' decisions through active engagement, we believe we will be able to make better informed investment decisions. So with that, let's turn away from the environmental side of ESG and turn to the S, and the social issues instead. Over to you, Måns.
Thanks, Nick. Yeah, so historically, the ESG community has been very focused on the E in ESG, but perhaps that's because it's easy to quantify that. But we've seen more and more investor interest in the S in ESG, or social factors. And that's been driven by the impact and valuation we've seen from conduct issues in the banking industry, the rise of automation, artificial intelligence, underpayment of workers, etc. And like we said before, intangibles are becoming more important. And it's interesting to note that many of those intangible drivers in a company actually belongs to the S, or social factors. So it is important for investors to understand a company's culture, its safety risk management, its ability to attract and retain talent, how it manages its supply chain, etc. And many of the UN SDGs that Nick talked about before also tie in with the S in ESG. For instance, one of the indicators is to eradicate slavery by 2030. And that links with what we think will be a major driver and theme in 2020, namely the Australian Modern Slavery Act. So before I talk about the law specifically, if we just take a step back, it's interesting to note that it's been estimated that over 40 million people globally who live in modern slavery conditions. And that includes things like forced labor, the worst forms of child labor, trafficking, bonded labor, which is when people pay a bond to get a job, then they have to pay off the debt whilst living and working in squalor. And most of these modern day slaves live in Asia, which means Australian companies' supply chains have big risk exposure. It can also be noted that it's been estimated to be between 1,500 and 15,000 modern day slaves here in Australia too. Internationally, the industries at the highest risks are construction and building materials, electronics, mining of gold and tin in Africa, fishery and some consumer goods. And then domestically here in Australia, some of the hotspots for slavery are car washes, the fruit and veggie supply chain and cleaners, and particularly vulnerable are migrant labour. And key products at risk imported to Australia, for instance, include electronics from China, garments from India and Vietnam, rice from India, and cocoa from the Ivory Coast and Ghana. So it's a big problem, and it's often hidden far down in the supply chains. But it's also important to look at the industry dynamics to understand where the risks are. So for instance, oligopolistic industries, where you have a small number of players putting significant pricing pressures onto suppliers, which increases the risk of subcontracting and underpaid workers. Also supply chains for many intermediaries, as well as supply chains with migrant workers and long and complex supply chains. So go to the next slide, please. Coming back to the Modern Slavery Act, in 2016, we issued an investor statement on slavery, pointing out that this is more than just an ethical issue. And companies mismanaging the supply chain can have their key assets, their brands, tarnished. The way a company deals with the supply chain can be a bit of a proxy for management quality, and ultimately comes down to earning sustainability. The slavery is illegal, so supply chain that depends on slave labor will unlikely produce sustainable earnings. That's the key point. And the UK has a Modern Slavery Act in place since 2015, and in 2017, Australia said they wanted to do something similar. So in 2018, we were appointed to a panel of experts to assist the government to issue the guidance for the Modern Slavery Act. So what is it then? Well, it is a transparency act. And at this stage, there's no penalties. But the act demands that any organisation with an annual turnover of $100 million and operations in Australia need to issue a Modern Slavery Act statement 6 months after the end of financial year end at the latest, which means we'll see the first statements between June and December this year. It's going to be a big topic. This statement is to address 7 mandatory reporting criteria, and they essentially boil down to 3 things. A, what are the risks of slavery in a company's operations and supply chains? B, what have they done to address those? And C, how do they measure the effectiveness of those actions? Now, the Modern Slavery Act in Australia is quite powerful compared to the UK version, because the Australian version has a mandatory reporting requirement, as I mentioned before, and all the statements will be uploaded into the same place, where they will be scrutinised by media, NGOs and consumers, which means there will be a significant reputational risk. You could argue that there's some indirect financial risk too, because the government itself will be reporting on their procurement activities. So if you're a supplier to the government and you do a bad job on slavery, you might even lose that contract. There's also another major difference between the Australian and the UK Modern Slavery Act, because in Australia, it also applies to investors in our investment portfolios. So we need to report on the risk of slavery in our investment portfolios, what we've done about it, etc. So it's a big driver. And there are no good precedents really internationally. So last year, ourselves, through the Responsible Investment Association Australasia, and AXI got together to write a specific guide on how investors can be reporting on this. You can find that on our website. So we go to the next slide, please. Thank you. So what does it mean in practice then? Well, first, investors need to understand the risks the companies we invest in. And that can be done by mapping out where they operate, where their supply chains are. For instance, there's a good resource called the Global Slavery Index, or the GSI. But the bigger the portfolio, the trickier it's going to be, of course. And perhaps some investors will just report on a higher level. Second, in terms of actions, we've been engaging with companies on human rights issues for a long time. And for us, it just means we just need to keep plugging away on that. In the last reporting season, we spent a fair bit of time with companies on how they're preparing for the Modern Slavery Act specifically. But we think it's dangerous to look at modern slavery in isolation. Modern slavery doesn't really just happen. Often it takes years of poor labour practices for slavery to occur. So slavery needs to be seen in the context of wider human rights issues and corruption, because it is linked to corruption, because slavery happens in the cash economy and it's an illegal activity, which means it's closely tied to money laundering risk. So our engagements are focused on encouraging companies to adopt what we think is industry best practice. So over the years, we've visited factories in China, Cambodia, Thailand, and Bangladesh, and other places where Australian companies source from. And when you go to places like that, you never get to see the worst factories. In fact, you probably get to see the best factories, but you also get to speak to the leading retailers internationally. And that has value to us because we can then speak to workers, unions, factory owners, and leading retailers on the ground. And you can learn about the complexities. You can learn about what leaders are doing. And then you can take that information and knowledge with you back home. And then when you engage with Australian companies, you can try to make them adopt what leaders are doing. I mean, that could be a webinar in its own right, so we're not going to cover that today. We just want to make sure you're aware of the Modern Slavery Act, what it is and what it means for investors. But pleasingly, many companies have listened to our advice, and in the process, they're at least reducing the risk of labour rights scandals in the supply chains. We think that's good. That said, the risk is still there. Slavery is illegal. It's often hidden deep down the supply chains. The supply chains can be very long. So just think for a minute about just a normal cotton t-shirt, for instance. It starts with cotton growing, perhaps in Uzbekistan, where child labor used to be very common. Then the cotton is ground, it's milled, it's weaved into textiles, then it's dyed, and then it's transported to garment factories where it's made into clothes. Now, most retailers only audit their factories at the last stage, in other words, where the cutting and sewing happens. But there's a massive supply chain behind that, of course, with many intermediaries and many different players. Many of those are very labor intensive, which means it's quite difficult to ensure that everyone in the supply chain has a living wage, particularly if a t-shirt is retailing for $2 or $3. So essentially, investors have a big role to play here, and we believe any investors who say they integrate ESG should be on top of this. If not, they probably shouldn't make the claim that they integrate ESG. So with that, the webinar is coming to a close. Just want to go through a quick summary. So hopefully this webinar has provided you with a summary of the latest developments in ESG. But just to reiterate, ESG integration can mean very different things to different people. To us at Ausbil, it really comes down to making better informed investment decisions and then engagement on ESG. And increasingly, value is driven by intangible factors. So it means it makes sense for us investors to understand how companies are managing those. We also want to point out that ESG integration is driven by changes to societal values. Actually, some of the companies in the reporting season even mentioned that specifically, and how that's changing capital flows. And the number of ESG-related share price impacts in recent years are also driving ESG integration. But when you integrate ESG, whether you use external or internal ESG research like we do, it just needs to be done in a way that is aligned with your investment philosophy, or it will be something, or else it will be something very separate. And like Nick was saying, the responsible investment industry is growing, but it's also evolving with more and more focus on engagements where people want to see outcomes, but also momentum on ESG. And we've talked about a number of initiatives and used quite a few acronyms today, but hopefully now you know more about the UN SDGs, or the UN Sustainable Development Goals, or the TCFD framework, or the Task Force for Climate-related Financial Disclosures, and then Climate Action 100+, and the Plastic Solutions Investor Alliance, the PSIA, and also the MSA, or the Modern Slavery Act. Just to reiterate on those three key themes we focused on at the second part of the webinar. On climate change, we do see an inevitable policy response at some point. Companies are moving ahead of regulators already. We've talked about the challenges with carbon footprint, and while we think the TCFD is a better framework for companies to describe risks and opportunities in a decarbonised world, it also applies to us investors. We need to report ourselves. And then we've talked about the Modern Slavery Act and how that's going to drive more interest in the S of ESG, and how there's 40 million people living in slavery globally. It's a big topic, and there's no easy solutions, but we think investors can play a major role. So with that, we'd like to say thank you for attending the webinar, and hopefully you know more about the latest trends in ESG, and happy to take questions. Thank you.
Excellent. Thank you very much for that, Måns and Nick. Very interesting topic. I definitely learned something new today, and hopefully we can provide more information on ESG investing in future webinars and resources that we put out. I'd like to now jump to some questions. It's not too late to submit a question if you'd like to ask Måns and Nick a question. Just to the right of your screen in the question panel, you will be able to ask any questions. Today's slides and presentation will be available. It will be emailed to everyone that registered and attended today. Look out for that email. That mid-Monday morning, you will receive that. So I have some questions come through, Nick and Måns, and I'll try my best to pull these out in a helpful order. The first one is about the financial advice industry. Does the financial advice industry need to work on better explaining or defining ESG investing to their clients to avoid confusion and ensuring that clients, how they view ESG investing is aligned with what it actually is?
Yeah, I think that's a great question. I think it's very good because, like we said before, ESG can really mean so many different things to different people. On the one side of a spectrum, you have ethical investors where they just screen out tobacco and alcohol, and then you often expect a lower return for that. Whilst the way we try to do it, and the way the whole industry is evolving, I guess, is you use ESG to drive better investment returns. Ultimately, that's the goal of it. So I think there's a lot of myths from that stem back to the ethical investor days, where people just assume that by integrating ESG, you actually make a lower return, and that's certainly not our experience. And then, of course, it's always evolving. So I think better education, I think, is really key. And then it's also quite difficult to know exactly what clients want on ESG as well, because in our experience, well, I mean, we have an ESG fund, for instance, and we screen out companies for certain attributes there, but you have different opinions on that too. Most people agree that tobacco would not fit into sustainable investment portfolios, but also people who disagree with that and say tobacco is a choice. So you're dealing with a lot of different views, and we think the more you steer towards an ethical portfolio, the more of those challenges you will have, because people's ethics might differ. The way we try to do it is to look at sustainability of earnings. So like Nick was saying before, if a business model, if you look at plastics, for instance, if a business model relies on underpriced pollution or externalities that haven't been paid for, we think that's going to drive lower earnings over time. And that's the way we try to do it. So maybe focusing on the earnings angle, long-term earnings, that might be a better way of explaining ESG, we think. But it is a problem because there is so many different views on what ESG is. And hopefully these studies that we produce today also show how by integrating ESG, you can actually drive better returns.
Yeah, absolutely. And I think that sort of leads into the second part of that question, is that clients often do want to invest in the greater good, and there might be some certain funds or products out there which might be involved in some clever marketing and potentially have high fees attached to them. How can financial advisors help clients, or how can investors look at these companies and see past, for example, some clever marketing?
Yes, yeah. I mean that's what we refer to as greenwashing. There is a lot of that, and it's tricky. But it's also tricky when you look at if you look at the Australian market. If you want to invest in renewable energy, for instance, well, there aren't that many companies to choose from. If you look at AGL, which is the biggest renewable energy player in Australia, it's also one of the biggest, or if not the biggest, carbon emitter in Australia. So that in itself makes it quite difficult, we think. And then you have the SDGs, where some investors might say, well, we invest in ResMed because we support the SDGs. But the truth is, they probably invest in ResMed because they believe in the earnings profile. So that is tricky. I'm not sure what the right answer is to get around that. Personally, both Nick and I think engagement is very important, because if you're investing to change the world, well, you can either just divest all stocks that you don't think meet your criteria, but what happens then is those stocks end up in the hands of someone else who does no engagement whatsoever. And we think by engaging with companies, holding and engaging, in some cases you can improve those companies. Not all of them, of course, but you can make changes over time. And we think that's probably a better, productive way of doing it. And we're blessed with good corporate access in a small market like Australia. And if you're interested in engagement, I can also just flag that we've just produced our ESG engagement report. So that covers all the engagements we did last year. I think it was about 175 different engagement types we had last year, seeing companies, asking them to do certain things to improve their sustainability profile, but also then engaging with regulators like the Australian government on the Modern Slavery Act, etc.
Okay, well, maybe that would be a good resource to include in our post-webinar email to all of today's attendees. Sounds like a good resource.
Yeah.
Thank you very much. The next question I have here Are there any particular countries which are leading the way in terms of ESG investing?
Yeah. I mean, okay. I think the Nordics in Europe, Scandinavia, have often been quite forward-thinking on that for a long time. I think Europe has in general, but particularly Northern Europe. I think Australia is up there too. Like every year I go to the PRI, or the Principles for Responsible Investment conference in wherever that's been held, and I'd say Australian investors have a good grip on ESG as well. Where it's different, of course, is our investable universe is very different from that in Europe, because we are a very resources-based nation, which means, you know, we're dealing with a lot of big carbon emitters, etc.
Yeah.
But in terms of maturity, I would say Europe is ahead of the rest of the world, and Australia probably sits right behind that, maybe. And then the US is more of an emerging field in the US still. It's not as sophisticated as it is here, and certainly not as sophisticated as it is in Europe. In Asia, it's a bit of a different investment industry too. But I think they often have quite significant corporate governance issues there because of the way some of those companies operate. But more and more we're seeing regulators looking at ESG requirements for reporting, etc. there too. So Asia is also a big emerging market, and I think that's going to be the biggest emerging market in terms of ESG integration and responsible investment going forward. But you can also see that through the membership of the PRI. Most members today would be from Europe, Australia, and the US. I think Australia certainly punches above its weight in terms of the number of members. And in Asia, there's more and more signatories coming through that too. So I think that's a sign that responsible investment is also increasing in Asia.
Interesting. Thank you. One final question we'll touch on today. Can ESG apply to not-for-profits and their management of volunteers?
Sorry, can you rephrase that question? Sorry, repeat it.
Can ESG investing also apply for not-for-profits and their management of volunteers?
Management of volunteers. Not sure how to best answer that question, really. Like
I'll package that one. I'll package that question up and send it over, and reach out to the individual who asked it, and I'll see if we can formulate a full response for.
Yeah, I'm just thinking thinking outside the box a bit. Like I know family offices, for instance, there's a big demand for ESG there. I mean that's not really not for profit perhaps, but yeah, we're seeing more and more links between ESG and charities and NGOs in general. Like we often speak to NGOs in terms of doing our research, because we think sometimes the NGOs and charities might have information about companies that we might not have access to, and they often do a lot of good work on the ground. They can also help companies, so we often advise companies to collaborate with NGOs. And I think the whole how to put it, the relationship between companies and charities and NGOs has become much more amicable. In the past, you had a lot of charities and NGOs criticizing and speaking up against companies and naming and shaming them. I think now they want to work more in collaboration with companies. So, for instance, complex issues like slavery, etc. Well, the NGOs and charities often have better information and better tools available, and they can work with the victims on the ground. So there's more collaboration there. That's what we say on ESG and charities, I guess. There's a bit of collaboration happening there. But in terms of investing specifically, I probably need to have a think about how that applies.
Okay, interesting. Thank you. The last question we'll touch on today, with the Modern Slavery Act, there's been a number of large professional service organisations in the news recently around underpaying and overworking staff. Would the Modern Slavery Act apply in those situations as well, where potentially graduates or interns are being grossly underpaid for the work that they're doing?
That's a great question, and unfortunately, it doesn't get covered specifically by the Modern Slavery Act. But we think, and that was one of the key points we want to make on that slide too, is it's dangerous for companies to only look at modern slavery in isolation, because modern slavery, it's the worst form of labor exploitation, but there's a scale there. So often modern slavery emerges in companies and supply chains where there is a lot of bad labor practices in general. So the step from underpayment of workers to modern slavery, in some cases, isn't that big. So we advise companies to look at it from a more wider perspective. And it makes sense, right? Like let's say you're a retailer, you have never looked at the issue of slavery before. The first thing you need to do is to map out your supply chain. You need to understand exactly where you're sourcing from, what are the conditions there. So that's going to mean a big expense, and it's going to be time consuming to map out your supply chain. So why not kill more than one bird in one stone and actually look at other types of labor rights issues as well? And we have seen quite a few of those underpaid workers, those scandals in Australia. In some cases, we think they have been driven by technical errors and IT issues. In other cases, we think there's more of a systemic issue where there's been too much pressure put on suppliers, and those suppliers might only have one lever to pull. Same thing in the franchise industry, where input costs might be going up, rent might be going up, but the franchisee is getting too much pressure from a franchisor, and the only lever they have to pull is labor costs. So they're taking shortcuts on labor standards. It's not going to be covered by the Modern Slavery Act per se, but we've seen what that can do to share prices when companies reveal these underpayment issues.
Okay, very interesting. Any questions that we haven't had a chance to answer today, I'll be sending those over to Måns and Nick to respond to after today's webinar, if that's okay with yourself, Måns.
Yeah, of course. Yeah, that sounds good. Thank you.
Excellent. So just to clarify, everyone, today's presentation along with the slides, CPD points, will be emailed out to you early next week. Once again, I'd like to thank Måns and Nick for joining us today to discuss ESG investing and the key factors to understand for 2020. Thank you, Måns and Nick.
Thank you.
Just before we end today, you might be interested in looking at some of the Ausbil managed funds on our Compare Funds and Models page. And also keep a lookout for our Portfolio Construction podcast series, where we will be actually recording a podcast with Måns later this month, which will be available through our website, Spotify, Apple, and anywhere that you get your podcasts from. One last note for today's webinar, you might be interested in learning more about Banker. Banker is a financial literacy program which Netwealth champions. It's active across 170 schools, with more than 8,000 participants. You can refer a teacher to deploy the Banker program within the classroom, and essentially it teaches young kids the skills and good money habits, which I'm sure we'll see them throughout their life. Well, that concludes today's webinar. Thank you very much for joining us, and we look forward to hosting the next webinar in April. Thank you.